Crypto trading, what does it mean and how does it work? Whether you're new to crypto or have some experience, understanding how trading actually works is vital. So today, we're breaking it down in simple terms. What crypto trading is, where it happens, and the different ways that people approach it. Welcome back to the Binance Stews. I'm Jessica, and if you're new here, make sure to subscribe so you don't miss helpful content like this. Let's start with the basics. Crypto trading is the buying and selling of digital assets like Bitcoin, Ethereum, and thousands of other tokens. It's similar to stock trading, but with some important differences that make the cryptocurrency space so unique. Now, one of the biggest differences is that crypto markets never close. While traditional stock markets shut down at 4 p.m. and take weekends off, crypto runs 24 hours a day, every single day of the year. This means prices are constantly moving, even when you're sleeping, and opportunities don't wait for Monday morning. So where does all this trading actually take place? Well, most trading happens on centralized exchanges like Binance. An exchange is essentially a trusted platform that connects buyers and sellers, making trades possible. When you place an order, the exchange does the heavy lifting. It matches you with other traders, processes your transaction, and updates your account balance. The advantage of using a reputable centralized exchange is accessibility and reliability. When you choose a trusted platform like Binance, you also get responsive customer support, high liquidity, meaning your trades execute quickly, and access to features like spot trading, futures, and even margin trading. Now, choosing the right exchange is probably one of the most important decisions you'll make in your crypto journey. If Binance sounds like the right fit for you, we have a complete step-by-step guide to help you get started. But centralized exchanges aren't your only option. There are also decentralized exchanges, or DEXs for short. Some people prefer decentralized platforms because they align with crypto's core philosophy: no middlemen. Instead, you trade directly with other users through smart contracts. You simply connect your wallet, approve the transaction, and the trade happens directly on the blockchain. The main advantage here is self-custody. You maintain complete control of your funds through your personal crypto wallet. However, decentralized exchanges can be more complex to use and often have lower liquidity than their centralized counterparts. The choice between centralized and decentralized really comes down to what matters most to you. Check the link in the description for a handy comparison that really breaks down the pros and the cons to help you decide what's right for you. Now, once you've chosen your exchange, you'll quickly discover the different types of trading markets that are available. Spot trading is the most straightforward and also where most beginners start. This is simply buying and selling at current market prices for immediate settlement. Futures trading operates differently. Instead of buying crypto right now, you're entering a contract to buy or sell at a specific price on a future date. Essentially, you're betting on where the price will go without actually owning the underlying asset. While the profit potential can be higher with futures, the risks are equally amplified. Now, margin trading lets you use leverage to borrow funds to make larger trades than your account balance would otherwise allow. This can significantly increase both your potential rewards and potential losses, and it requires careful consideration and also risk management. Options trading gives you the right but not the obligation to buy or sell crypto at a predetermined price by a certain date. You pay a premium upfront, and if the market moves in your favor, then you can choose to act on it. And lastly, there is peer-to-peer trading, or P2P, where you trade directly with another person. Binance offers secure P2P services that holds the crypto in escrow until both sides confirm the transaction. If you're curious about how it all works, watch our detailed beginner's guide on P2P trading. Now, when choosing the platforms, consider which tokens you actually want to trade. While most major exchanges support large market cap assets like Bitcoin and Ethereum, some tokens might only be available on specific platforms. Now, this could be due to an individual listing requirements, regulatory considerations, or where projects teams choose to launch first. New projects sometimes partner exclusively with one exchange before then expanding to others. You can easily check which tokens are available on sites like CoinMarketCap. You just search for a project and you'll see exactly which exchanges list it and also which trading pairs are supported. Binance offers one of the most comprehensive token selections in the industry, and you can view the full list of supported assets and pairs directly on our website. Okay, so you've identified the tokens that you want to trade. You've picked your ideal trading platform and you've got a good understanding of the fundamentals of crypto trading. Now, it's all about how you trade. There are so many different strategies and there's no one-size-fits-all approach. The right one really depends on your goals, time, and also your risk tolerance. Some traders are scalpers. They'll make dozens or even hundreds of small trades a day, capitalizing on tiny price movements. It's fast-paced and requires constant attention. Day traders focus on short-term price movements, the opening and closing of positions with the same trading day, looking to profit from short-term market volatility. Now, we also have swing traders that take a different approach, trying to capture larger price movements that might unfold over days or even weeks. They often time their trades around major news events or market catalysts that could impact prices. Position traders are all about the big picture. They might hold positions for months or even years, focusing on the fundamental long-term value of an asset rather than short-term price fluctuations. And then, of course, there is HODLing, a strategy so popular it became its own crypto movement. HODLers buy and hold for the long haul, riding through any ups and downs with the belief that the prices will rise significantly over a long period of time. Well, these represent just a few common approaches, and many successful traders combine elements from different strategies to develop their own unique style. For a deeper dive, check out our video on essential crypto strategies, the must-know for success. So crypto trading can be both exciting and rewarding, but effective risk management is essential. Prices can swing dramatically, especially during periods of high volatility. Having a solid strategy helps you to stay disciplined when markets can be unpredictable. If you're ever in doubt, just zoom out. The bigger picture often tells the real story. In Bitcoin's case, its long-term price trajectory, it speaks for itself, despite plenty of short-term ups and downs. Education also is your strongest tool. The more you understand, the better your trading decisions will be. To learn what really drives crypto prices and how to trade confidently in any market condition, be sure to watch our video on why crypto prices move. Until next time, trade smart, stay safe, and thank you for watching. We'll see you in the next one.